10% of your grade, and we drop the lowest one. So just do it for practice. Do it with your friends if you don't understand. I really appreciate everybody coming to me now at the beginning of class to try to understand the problems that they didn't get right. So please keep doing that. I would also recommend going to the tutorial on Friday. I hear there was a really good turnout. So if you're having trouble with the assignments, you can also ask the TA Hanning, okay? What else? Oh, I've posted videos from week 2. They should be on the Learn week 2 page at the bottom. So if at some point someone could have a look, see if they see those and see if they can view them. And then it's something that I'll try to do every week, okay, so that you guys can view the lectures on your own time. Third thing is, I didn't get any responses on the request for note-taking. So what I'll do is, I'll ask again. If no one is interested, I'd ask that the student who requested it, please come talk to me either during the break or after class, or send me an email, and we'll see what alternatives are available. Okay? All right, so moving on to chapter 4. So what did we, was there a question? Yeah. Moving on to the week 4. So last week, the kind of big takeaway was assets equals liabilities plus equity is the same as debits equals credits, right? And a journal entry is the way, it used to be a physical entry in a journal, but it's the way we capture transactional information and we encode it into debits and credits, and we record the entry, and then we post the entry to the ledger, and this is how we tell the system, here's the economic transaction, here's how it translates into accounting information. Every entry will always have debits equaling credits, and you always have to have at least one debit and at least one credit. You can't have 2 debits and 0 credits, and you can't have 2 credits and 0 debits because your entry won't balance, right? The other thing is, do not try to memorize assets increase with debits, assets decrease with credits, liabilities increase with credits, decrease with debits. All you need to know is that assets increase with debits, because all the others are mutually exclusive. If assets increase with debits, that means they decrease with credits. And you know that on the other side of the equation it's reversed. So you know if assets increase with debits, then liabilities and shareholders' equity decrease with debits, and therefore they increase with credits. Okay, so you can sort of solve for all the other 4 as long as you know one. So don't get yourself caught up in memorizing every possible situation. Okay, try to understand that as long as you know assets increase with debits, then you have all the rest. And remember, revenues and expenses are just part of shareholders' equity. Okay, so they follow the same shareholder equity rules. Because revenue increases with credits, or rather, when you have revenue or net earnings, positive net earnings, that increases shareholders' equity. Because you increase shareholders' equity with a credit, that means that revenue is a credit balance, right? It's all on the credit side. Oh, okay, so with that being said, why don't we move on to some of the chapter 4 material? Okay, the other thing is, we're only going through one chapter this time. Last week was a little bit rushed. There was a lot of content. So this week, we only have one slide deck. How it's going to work is I'll try to move through it as efficiently as possible. We'll do a 10, maybe 15-minute break. When we come back, we'll do the problems for the day. So I know last week I didn't get a chance to do the problems. This week we will do the problems, but I'll give everyone a chance to head out or pack up if they want after the lecture is done, if you want to do the problems on your own. Now, do you guys look at, we posted the problem solutions for last week on Learn. So hopefully you looked at those. They're correct, but they don't always explain the logic, okay? All right, so chapter 4, adjustments, financial statements, and quality of earnings. Okay, so we talked about this in lecture 1. Management is responsible for preparing the financial statements. Management are the people that, so we as investors elect a board of directors, and the board of directors look out for us, And the board of directors then hire a manager or a group of managers, collectively known as management. And they prepare the financial statements because, I mean, they hire accountants and they're the ones who are closest to the business. What do we care about? We want the financial statements to be high quality. Remember we discussed that chart that showed the characteristics of financial statements to make them useful, right? They have to be relevant and they have to be reliable for them to be useful to us as investors or banks as creditors. Okay, what's the accounting cycle? So at the start of the period or during the period, we analyze transactions. That's what we discussed last week. We'll make sales, we'll collect receivables, we'll take on bank debt, right? We'll pay our suppliers. We record the journal entries for each transaction, and then we post the amount to the general ledger, which is the T accounts, right? The T accounts keep a running balance of all of the accounts. After every journal entry, you could, in theory, update the T accounts, right? You can now flow that through to the T accounts. At the end of the period, so let's say our year end is December 31st, we have to make some adjustments. These are called adjusting journal entries, okay? And they're functionally exactly the same, but the understanding of why we make them is a little bit different, okay? They're more internal transactions than external. Then we can prepare the financial statements and disseminate these to disseminate means to just give out to the users. And we'll talk about this other step too. We close revenues, expenses, and losses to retained earnings. So you'll see how that looks. Okay, so phase one, the external transactions, that was last week, right? You should all be thoroughly familiar with this between the lecture as well as last week's assignment and the problems. So now we're going to talk about phase two at the end of the accounting period. So once we've posted all of the journal entries, we've gone through all the 200,000 journal entries that we made throughout the year. We post them all to the T accounts. Now we prepare what's called a trial balance. And this is not an official financial statement. What the trial balance does is it lists from our chart of accounts every account title. Just down in each row you'll have cash, accounts receivable, accounts payable, retained earnings, revenue, etc. You'll have all the accounts, and it'll have one column for debits and another column for credits, and it'll show the balance of each of these accounts. It's just a quick way to look at every account we have and all the balances. Now you know that debits equal credits at the start of the accounting period, and after every transaction, debits have to equal credits. Therefore, your trial balance should balance, meaning all its debits should equal all its credits. That doesn't always happen, unfortunately. So I'll show you an example of that. But after we prepare the trial balance, we analyze the account balances. So what does that mean? That's not really descriptive. We're going to go over what it means to analyze these account balances. We record and post adjusting entries. When we say record, what do we mean? We enter a journal entry. We record an entry into the journal. When we post, we say we take that information from the journal entry and put it to the T account, to the general ledger. Then we can prepare financial statements, and then we record and post closing entries. And then we end the accounting period. Okay, so this is very similar to what I said. Notice how the adjusting entries only occur at the end of the accounting period, okay? They don't occur throughout. I mean, they can, but for the most part, they occur at the end. Okay, so the reason we have to make adjustments goes back to the matching principle. And that's because we have to record the expenses in the period that the revenues were earned. Right? So if you need to pay your chefs to earn revenue in your restaurant, you have to record the expense of paying the chefs at the same time you earn the revenue from selling the food, right? But because transactions occur over time, and our financial statements, so our income statement or a statement of comprehensive earnings accumulates throughout time, but there's a definite end date. And our statement of financial position has a definite end date. The problem is things are continuous, right? So we're forced to sort of chop things off as at our year end. So it's important to get the revenues and expenses into the right period. This also goes back to the deferred revenues. Remember that we were talking about last week, deferred revenues and prepaid expenses. So I believe we saw this chart last week. Is that correct? This is just a sort of more visual representation of deferred revenues or accounts receivable or accrued liabilities or prepaid expenses. And this just sort of gives you an example of what happens when you pay cash or you receive cash before the underlying substance of the transaction has occurred, before the expense has been incurred or the revenue has been earned. Okay, so again, this should be review from last week. Deferrals are receipts of assets, meaning we get cash today, or payments of cash in advance of revenue or expense recognition. An accrual is the reverse, where we've earned the revenue or we've incurred the expense, it just hasn't been recorded yet, and we haven't paid anything yet. Okay, this is what I was saying about the unadjusted trial balance. So it's a listing of individual accounts. Usually they go in financial statement order, okay, but we don't, here, you'll see what I mean. It'll probably be better to show it. This here is an unadjusted trial balance. So, a couple things to note. We have all of the typical account titles that you would expect to see, right? Cash, trade receivables, furniture and fixtures, note payable, common shares, revenue, cost of sales. These are all line items that appear on your financial statements, on either your statement of financial position or your statement of comprehensive income. But notice how we're not segregating them. All we care about is, as at the year end, at December 31st, does it have a debit balance or a credit balance? And notice how all we do is we take the totals. This will be the total from your T account. So you would go to the cash T account at the end of the period after you've posted all the journal entries and say, okay, our total cash is $3,900. And you'll notice that the debits, $57,385, equal the credits, $57,385. One thing to note, this retained earnings, notice the date. This is, sorry about that, this is beginning. This is beginning retained earnings, okay? This is at the beginning of the period. And then we have sales, revenue, cost of sales, and operating expenses. Okay? Now there's a couple of line items that you shouldn't yet recognize on here, and that's these: accumulated depreciation and accumulated depreciation equipment, furniture, and fixtures. So what is happening there? These are called contra accounts. So remember how I said that assets are absolute numbers, meaning you can't have a negative asset, you can't have negative weight, right, or negative height. So this is the exception. Contra just means against, right? So you have these contra assets, and these are account balances that sit against another account. They're directly related. Okay, so the accumulated depreciation equipment is directly related to the equipment. And the accumulated depreciation furniture and fixtures is directly related to furniture and fixtures. You'll never see a contra asset account with a greater balance than its associated asset account. Okay, it can only have a contra balance up to the balance of the assets such that the net is zero. We'll show you what these accounts mean. But, okay, you know what? Why don't I explain it now? So, when we buy this equipment and the furniture and fixtures, what's the journal entry? Let's say we buy it for cash. So let's say we bought equipment of $4,800 for cash. So debit equipment, $4,800, credit cash, $4,800. The goal is to use this equipment to generate revenue over a number of years, right? The definition of an asset is that it has future economic benefit. The same way your laptop will last for 3 years and your phone will last for 2 years. Okay, you might not use them to generate revenue, but it lasts for a long period of time. So let's say we were to keep the equipment on the statement of financial position at that historical cost of $4,800 for the next 10 or 15 years. Well, what's the problem? A, we're using it to generate revenue, but B, it's probably wearing out, right? It might only have a 5-year life or a 4-year life, after which time it won't be able to generate revenue for us anymore. So what we do is we actually allocate the cost of the asset over its life to offset part of the revenue by recognizing an expense. Okay, so what happens is after the first year, let's say we bought the equipment for $4,800, and then 1 year passes and we use it in our operations, and we've used about, a quarter of it? Let's say we think it's only going to have a 4-year life, so we've used about $1,440 worth of it. What we're going to do is recognize an entry called depreciation expense. Okay, and depreciation expense is just the allocation of cost of that asset over time. And that's going to show up on our statement of comprehensive income. If we're debiting depreciation expense, something has to be credited. Well, we could, in theory, credit the value of the asset, right? We could just reduce the asset by $1,440, but we break it out into a separate account so we can analyze the balance, so we can see it separately, okay? That's the only reason we do it. There's really no harm in crediting the asset directly. But all this says is you've used part of the asset. The same way, if you have a prepaid phone plan for 6 months, after 1 month, you've used 1 month, you have to recognize the expense. By prepaid phone plan, I mean you went to Rogers and you paid them, let's say $60 a month for 6 months, so $360 in cash, credit cash, debit prepaid expense. And then over time, the prepaid expense comes down and you recognize an expense. The debit moves. The same goes for long-term or fixed assets. Now, I probably said this before, but I'll say it again. The only reason businesses have assets is to generate revenue. Okay, they're not like you and I where we might have a piece of art on the wall because we like it. For no other reason than we like it. It's not there to generate revenue, right? Your computer's okay, maybe you need it for work, but a nice pair of headphones, you probably don't need those to generate revenue. You consider them an asset, but from a business perspective, assets are always used to generate revenue. There's no other purpose for them in the business, okay? So you have to recognize the cost of that asset over time. So what happens is we have these accumulated depreciation. Accumulated just means built up over time. Okay, you have the accumulated depreciation over time. Next year, what will that account balance be? It'll be maybe double that, right? $2,800. Okay, and we're going to recognize another depreciation expense for $1,440. And eventually, in the 4th year of this asset's life, we will recognize enough accumulated, or rather depreciation expense, to bring its accumulated depreciation to be equivalent to the equipment value, the original asset value, okay? Such that our books sort of reflect the reality of the situation whereby we've used this for 4 years, okay? Now, here's why we break out a contra account and present them on the financial statements as such. So imagine you're an investor and you just saw one number there. You saw equipment, what's the net of that? We'll call it 3,400. Okay, let's say you saw equipment 3,400. Did we buy equipment for 100,000 and it's depreciated by 96,000? Or did we just buy equipment for 3,400 and there's no depreciation on it? How do you know? Those are two very different scenarios, right? Because if we have equipment that we bought a few years ago for 100,000 and it's now almost fully depreciated, we're probably going to need to buy new equipment next year, meaning we're going to need a lot of cash. If we just bought this equipment for 3,400 and there's no depreciation on it, we can probably go the next few years without buying equipment. Notice how it's the same net number, okay? But this tells us it's probably about a year depreciated, or we have about 2/3 or 3/4 of the life remaining. Okay, so that's why we care to break it out separately. So the equipment balance of 4,800 is called the cost. And that's what it cost us to purchase the asset. Okay? When you purchase your MacBook for whatever, $1,200, that was a cost. You're not saying that's what it's worth today. You probably couldn't resell it for that much. The cost doesn't change. The cost is what you paid for it historically. Okay, so we paid $4,800 for the equipment historically. The net book value is the cost less the accumulated depreciation. All of the depreciation entries we've made throughout the years, okay, have accumulated, and now we have a net book value. So in this case, the net book value is only $3,360. It's also called the carrying amount. So this just summarizes what I said. I highlight the bottom point here, okay? This is actually the exact same concept as deferrals and accruals for revenue and expenses, except what we went over last week was on a short-term basis. It was deferred revenues that you'll recognize next month or 6 months from now, or deferred expenses that you realize over the next few months. Long-term assets eventually get fully depreciated. It just takes them a much longer time, okay? But the debit balance always sort of returns to an expense. Even though it starts as an asset, it declines over time and increases in expense. And that's because the asset provides benefit over many years. We use the asset to generate revenue over many years. The example here, I used a vehicle for $10,000. We purchased a vehicle for $10,000. ePhone plans to use it for 5 years. The expense is $2,000 per year. Here's an example of the journal entry. Notice how I'm showing DR for debit. You don't need to do this on a midterm. You don't need to show DR, CR, and you don't need to show this. But you can if you want to. When you're practicing, I would highly recommend writing for yourself, DR, CR for debit credit. Writing plus E minus A. And notice the indent, right? Now, so in this case, credit accumulated depreciation, I put minus A. You might see the terminology plus XA, plus contra asset. Same thing. Okay, so going back to the unadjusted trial balance, and this has happened in practice to me, where your debits don't equal your credits. So what does that mean? That means someone was able to book a journal entry that was lopsided. Somehow it happens. I don't understand how, but this used to be done by hand up until computers maybe 50 years ago. So you can imagine there were a lot of instances of human error, right? You transpose, instead of writing 72, you write 27. And all of a sudden nothing balances. And now you need to go back and figure out where that mistake was made. So it doesn't happen as much anymore, but it can still happen. This is just a recap of last week, but it'll give you a refresher for why we're making these adjustments. So remember that deferred revenue, if cash was received and previously recorded, and then we recognize a revenue, okay, when we received the cash, the entry was debit cash, credit unearned revenue or deferred revenue. When we recognize the revenue, we have to lower this unearned revenue, this liability, and we get to credit revenue. Accrued revenue is the opposite, whereby we recognize revenue today, but we don't yet have the cash. Okay, and then so debit receivable, credit revenue. When we receive the cash in the future, we need to reduce the receivable, so credit the receivable and debit the cash. Okay, so that should be nothing new to anybody. The expenses are the exact same. A deferred expense is when cash was paid previously, but you haven't yet incurred the expense. Prepaid cell phone plan is a good example. You pay up front $100 for your cell phone plan. you get the asset, a prepaid expense, and credit cash. You haven't yet recognized any expense because time hasn't passed. You still have a full 6 months worth of cell phone usage. Every month, you have to reduce the prepaid expense. That asset is coming down, and you recognize the expense. Because at the end of 1 month, you only have 5 months left. At the end of 2 months, you only have 4 months left, right? Accrued expense is the opposite, whereby you've incurred the expense, but you haven't yet paid the bill. Okay, so you have a liability where you owe somebody. Hydro bill is a good example. Every day you use hydro, right? You use your air conditioning, your heat, and so every day you're recognizing an expense, you're incurring this liability, but hydro might not send you the bill for another 2 months. And then, so we're debiting expense, crediting payable. When we pay the payable, we debit the payable to reduce it, and we credit cash. Okay, this is just a graphical example. It's the same information, just presented differently. Okay, so journal entry, you guys should all be very familiar with this. Deferred revenue, cash is received before the company performs a service, and therefore before the company earns revenue. On December 1st, 2015, Tom's Rentals received a check for $3,000 for the first 4 months from a new tenant. So what happens on December 1st? We debit cash because we're getting cash in our bank, and we credit this deferred rent revenue. We have an obligation to provide a space or equipment, whatever we're renting, for the next 4 months. What I want you to notice is the date. Okay, we're December 1st, 2015. Our year end is probably December 31, 2015, okay? So every month, a quarter of the deferred revenue is earned, okay? But the important thing is, this is our year end. December 31st, 2015, 1 month later. So what should the balance in the deferred revenue be on January 1st, 2016? It should be the sum of the remaining deferred rent to be recognized, right? These three. So that's $2,250. Okay, so we now have to book an adjustment on December 31st, and no one is going to tell us to do this. So that's the key with an adjusting entry. With an adjusting entry, our accountant would go through the trial balance and see deferred revenue of $3,000. And they'd have to look and say, what does that relate to? And they'd say, oh, it was money received in December for 4 months worth of rent. And the accountant then has to go, well, we've used 1 month, or we've earned 1 month of that rent. We now have to recognize the rent revenue and reduce the deferred rent. So this entry is made by the accountant, but it's not as if our customer came to us and said, don't forget to book your 1 month rent journal entry. The customer paid us, they don't care, right? The onus is on us to book this adjusting journal entry on December 31st, okay? Another way you can think about it is, you know that your balance in deferred revenue has to be $2,250 going forward because you only have 3 months left. And if the current balance is $3,000, you know you have to reduce it, debit, by $750. Okay? So a great midterm question would be very similarly structured to this, except maybe I'll give you the date of October 1st, and I'll say 6 months. So if we received prepaid rent October 1st for 6 months, let's say $6,000, that's $1,000 a month. And how many months are there from October 1st to December 31st? It's 3 months, October, November, December, right? So at the adjusting entry would be for $3,000 of rent revenue. Credit rent revenue $3,000, debit deferred rent $3,000. Right? I mean, it's easy to make this complicated. What if I don't use nice, neat numbers? And what if I say our year end is November 30th? So you can't just memorize, oh, when I see deferred revenue, I'll recognize 1 quarter. You have to understand that it's 4 months of rent. Okay? In fact, when you're doing a problem like this, don't go ahead and book the journal entry right away. The first thing I want you to do is think about this here. Total, and then you know how many months you have, $750 per month. And then figure out how many months. Okay? After we post, remember we post the journal entry to the T accounts. Here's how the account balances look. Notice how on December 1st it was $3,000 credit balance, no rent revenue. We debit deferred rent revenue for $750. There's that balance, right? $2,250, which you should be able to calculate just based on this. You know that you now have 3 months left, right? You go 3 times 750 equals 2250. So you know that that balance is correct, right? If you have time on the midterm and you go back and you recalculate what the balance should be and you get a different number, your entry might be wrong, or you might have just made a manual error and typed the wrong entry into typed the wrong number into your calculator when calculating the balance. Okay, and our rent revenue is credit 750. So the key here is this is an adjusting entry. We're only making the entry because we're at month end. And we sort of have to settle up our books, make sure everything is good. Okay? But you actively have to go through the statement of financial position and say, what is this balance? What does it represent? And then you'll understand if you need to make an adjusting journal entry. If, let's say this transaction occurred on December 31st. So our unadjusted trial balance, before we make any adjusting journal entries, is going to show $3,000 deferred rent revenue. But in this case, there's no adjusting entry needed because time hasn't passed, right? So it's very important you understand when the transaction was made, where are we today, right? And what does that mean? What does that passage of time mean? Interest income. Okay, how does interest work? When you have money with invested in a bank or deposited in a bank in a cash account, they'll pay you a little bit, maybe like 0.25% or 0.5% per year, not very much, to keep your money with them, right? The reason the bank does that is because they can use that money, they lend out that money for more than it costs them to pay you. They'll earn 3% and they'll pay you 0.25%. So that's how they make their money. OSAP charges you interest, right? After you graduate, I think you have 6 months of interest free, and then as long as I think you're earning more than $30,000 or something per year, you have to start repaying OSAP with interest, right? So if your OSAP balance is $10,000, they say, well, you owe us 5% a year on top of that. So every year you owe an additional $500, okay, for interest. It's just the cost of money. If the bank pays interest at 1% per year, savings account balance of $1,000 will earn $10 per year. Okay. For those of you who aren't familiar with typing in percentages to your calculator, 100% equals 1.00. Therefore, 10% is just a tenth of that, or 0.10. And 1% equals 0.01 in your calculator. So if you wanted to know how I calculated this $10, you take 1,000, and then your calculator, you multiply by 0.01, and that'll get you 10, okay? So here's the thing, the interest is not always paid in cash by the bank immediately, but the owner of the bank account has earned it regardless. What if the bank says, we'll pay you 1% interest on January 1st every year, right? We'll sort of let it accrue because they don't want to be dealing with making a small payment into your account every month. So in this case, at December 31st, ePhone has earned, but has not yet received, interest, and a money market account is just short-term investments, okay, it's earned interest of $150. Now again, no one's telling us this. Okay, we sort of have to figure it out ourselves, but we've earned that revenue, right? So we need to recognize interest revenue and interest receivable. This functions no differently than any other revenue or receivable account. It just happens to relate to interest. The reason why we care about interest is because it's kind of different from the rest of our operations, right? We're not in the business of earning interest income. We're in the business of selling phones for profit. With the cash sitting in our bank, we happen to earn interest income. Okay, so investors care about breaking that out. Similar to how we break out gains from revenues. Remember how gains are sort of one time? Well, we realized a profit from selling this equipment that we don't need anymore, but we're not in the business of selling equipment for profit. Okay, so this is the same thing. We're not in the business of earning interest income. Some companies are in the business of earning interest income, like banks. We're in the business of selling phones. So it's important to know how much of our revenue is coming from interest income as opposed to revenue, true operating revenue. Okay, and the interest receivable, that gets cleared out when the bank gives us the money, right? When the bank deposits the $150 to our account, what's the entry? Debit cash $150, credit interest receivable $150. We've already recognized the revenue. They might not pay us for another 2 months, right? Nothing new here, accrued revenue. Cash is received after the company earns the revenue, after we perform the service. Okay, this is just a nice chart to help you understand. There's nothing new here, but I appreciate that people learn differently. Or if I say it 7 times, maybe the 7th time it'll really stick. So, deferred expenses or prepaid expenses. We pay the cash before the expenses incurred. Prepaid rent, advertising, and insurance are all good examples. I believe there was a question on the assignment that said we pay for insurance. I think we pay for 6 months of insurance today. That's prepaid, and every month you have to recognize 1/6 worth of the insurance, the premium. Your car is different. So for those of you who own cars, you pay monthly, right? But actually you have the option to pay at the beginning of the year. I don't think anyone does it, but you have the option to pay a lump sum the day one. In that case, you'd have a prepaid expense, right? Because you get the benefit of insurance for the next year. So how insurance practically works is premiums are paid, and premiums can be monthly or annual. Those of you who are in actuarial science, this is very important because you'll be going into the insurance business. And you pay these premiums to an insurance company. So there's car insurance, home insurance, health insurance, and there's life insurance. Right? You can insure anything, almost. So the insurance company makes a promise to cover the cost of a really big event in the future. So you pay maybe $200 a month for car insurance or $2,400 a year. But if you are in an accident and your car's totaled and it was worth $30,000, they'll pay you off. Right? So you think, well, maybe that's a good deal, right? You only pay $2,400 a year, but you get protection for up to $30,000, right? That's sort of how it works. I won't go into how insurance companies make money, but it's quite interesting. They're smart enough. They use actuaries, a lot from Waterloo, who figure out the probability of there being an accident and the likely cost of that accident, and they charge you that plus a little bit more so they make money. So that's why they always have enough money, right? You might think, oh, what if there's like 100 accidents in a day? They have, if everybody's paying a premium and they know that statistically speaking there's only ever going to be this many accidents in a day, they know they're only ever going to have to pay out $1 million. So that's how they make money. The insurance premium is very small compared to the potential payout. So it's generally a sound business and personal decision to pay for insurance to protect from big losses. It's considered a financial, financial innovation, that insurance. We're effectively pooling capital, right? Here's the problem. If you were an individual, let's say there was no insurance company. If you were an individual and you were worried about the fact that your home might catch fire or that you won't be able to afford if you have serious medical bills in the future. You could save as much money as you possibly could, but you still wouldn't be able to cover the cost of a catastrophic event. And yet if we all pool our resources, and we know that in any given year only 2 of us will die, well, we can use the power of probability to say if everyone pays in just $200 a year, you can be protected and your family will have money for when you pass away. So it's a financial innovation, right? It's quite a, and it's only, I think, a few hundred years old. I mean, insurance has existed for a long time, but insurance as we know it today, I think it's only a few hundred years old. So on January 1st, 2015, the date is important, okay? January 1st, ePhone paid $3,600 for a 3-year fire insurance policy. So at this point, do not go and try to do the journal entry. The first thing I want you to do is say 3,600 divided by 3 equals 1,200 per year. They're paying in advance for a resource to be used over 3 years. So the entry, I shouldn't say matrix, I should say ePhone, but the entry on January 1st to record the policy would appear as follows. Debit, prepaid insurance, credit, cash. This is nothing new, right? All we're doing is transferring cash. This is the same chart we saw for that deferred revenue. This just shows sort of graphically at each year end, we use up 1,200, okay? Here's the journal entry. At the end of the year, on December 31st, you recognize the portion of insurance consumed. Now it becomes an expense. Debit insurance expense, credit prepaid insurance. So here, this was a simple example because it was a 3-year policy and we were January to December, so we used 1 year. What if I said they took out the policy June 30th? Still a 3-year policy. So in the first year, you only recognize half a year, right? Only 6 months worth. So you have to be cognizant of what your dates are. Here's how the T accounts look. Nothing new. Oh, and this here, notice how the balance in our prepaid insurance is $2,400, which is the remaining 2 years of insurance at $1,200 per year. That makes sense, right? Nothing new, accrued expenses. When expenses are incurred but not yet billed, right? So if Rogers had the reverse sort of deal with you where instead of paying them every month, they say, we'll just charge you at the end of the year for your whole bill. Every month you're incurring the expense, right? Every month you have to record the expense. Okay, so here's a good example. As of December 27th, 2015, so 4 days before the end of the year, ePhone had paid $1,900 in wages for the year already. It pays its employees every Friday. Year end, December 31st, 2015, falls on a Wednesday. We report on December 31st, right, 2015. We haven't paid our employees yet. The employees have earned total wages of $500 for Monday through Wednesday for the week that ends January 2nd, 2016. So we're sort of forcing the cutoff, right? We're saying, okay, they've earned 3 days worth of wages as of December 31st, because that's our financial statement date, right? It might appear like a small number now, but if you're a massive company and you have a lot of expenses occurring every month, having that cutoff can be very important. So we recognize an expense for the wages because we owe it to our employees and the payable, but we haven't paid any cash. Okay, so here's how the T accounts look. Remember how I said the beginning balance was $1,900? So this is just another representation of the same thing. Okay, so here's the interesting thing. So everything we've dealt with now has been pretty concrete. And by that I mean, it's easy to say, okay, well, we know how much we pay our employees every week. we'll just take 3 of 5 days, right, or 3 of 10 days. We know how much we're paying for insurance for 3 years. We know how long the policy is going to be. We know how much cash we paid. It's pretty, there's no estimation required, right? The problem is a lot of accounting numbers are estimates. And that's because the amount of expense is uncertain. Depreciation. So in the example I gave earlier, we'll have this equipment, or we buy it, we expect it to last for 4 years. But it might last for 3 and it might last for 6, but you don't know today, right? It depends on how heavily you use it. It depends on, maybe it gets rusty, maybe a part wears out and the whole machine, is no longer usable. Bad debt. So that's one we cover in depth later in the course, but when we sell to customers, the expectation is that they will pay us, right? But they don't always pay us immediately. That's what the account receivable is. Inevitably, a certain proportion of our customers don't pay us. Either they go bankrupt, there's fraud and the owner runs away with the money and we don't get paid. So we need to estimate how much of the account receivable do we actually think we're going to collect. We hope it's 100%, but we know from historical experience that it's not. But you have to make an estimate about what's going to happen in the future. That's the problem here. You have to make a statement about what we expect to happen in the future. Income taxes are also an estimate, but I won't go too much into that. I mean, in theory, you have to think about what will tax rates be in the future. Well, that's kind of tough to estimate, right? What will the government do? What will Trudeau do 2 years from now? Who knows, right? So. Okay, so here's an interesting nuance about depreciation. Depreciation is not meant to say this is the value of the equipment. It is a cost allocation concept, not a valuation concept. What does that mean? So in the beginning, we saw that we had equipment with cost of $4,800 and accumulated depreciation of $1,400. That means the net book value was $3,400. That does not mean that is what we expect we could sell it for in the market today. Let's say someone wanted to buy it from us. They might offer us more or less than that, okay? That's not what the depreciation is meant to do. Depreciation is meant to be a systematic meaning it follows a system. We say a certain amount every year. And rational meaning it's based on the useful life of the asset. It's meant to be the systematic and rational allocation of the cost of a long-term asset over the accounting periods which it is used to generate revenue, okay? So what we're trying to do is allocate the cost over time. We're not trying to say that if you buy a car today and you use it for 3 years, this is how much you expect to sell it for in the future. That's not what we're saying. We're allocating the cost of the purchase over time because we're recognizing revenue over time, okay? So again, it's the net book value or the carrying amount will not be equal to the market value. Market value is what the asset would fetch on the open market. If we were to sell it today, how much would we receive? Right, so it's two different concepts. We saw this already. The required journal entry for depreciation is debit depreciation expense, credit accumulated depreciation. For some reason, a lot of people got this incorrect on the midterm last year, and I don't know why. They would sometimes debit accumulated depreciation and credit depreciation expense. The account titles are wrong. Sometimes they would just say credit accumulated. Accumulated what? You have to say accumulated depreciation. Debit depreciation expense. The other thing is, if you have multiple assets, multiple classes of assets, remember how in the trial balance we saw in the beginning I think there was equipment and there was furniture. They each had, yes, question? Yeah. Good question. So the question was, when you calculate depreciation expense, do you only need to be familiar with the straight line method? We haven't got to depreciation methods yet. You will be required to do, there's different ways of estimating depreciation. What we've shown you so far is called straight line because it just assumes an equivalent amount of depreciation every year, right? It's just a linear step down. There's other methods that are used for depreciation which more accurately represent the way the asset is used to generate revenue. So for now, we're just showing depreciation as a concept. We're using straight line because it's simple. We will get into different ways to calculate the amount of depreciation, but that was a good question. So as I was saying, if we have two classes of assets, if we have furniture and we have equipment, they're probably going to have different rates of depreciation. Furniture might last for 2 years, equipment might last for 10 years. So you have to be specific. You have to say depreciation expense, furniture, accumulated depreciation, furniture, okay? So this is a similar entry. In this case, it's giving you just detail of what the balances were. And it tells you you need to record an additional $400 of depreciation. And now we can see what the cumulative effect is, right? Notice how we have the credit here, which adds to the accumulated depreciation balance. Notice how depreciation expense is only $400. Why is it not $25,487? Because we recognize the depreciation expense in past years, right? Remember how the statement of earnings, and this will come full circle shortly, but remember how the statement of earnings accumulates effects from a date to a date. Whereas the balance sheet or the statement of financial position is at a date, and it's the cumulative effect of everything since day one, right? So the depreciation expense, the bucket this year only has $400 in it because it's in past accounting periods that we recognized all the other depreciation. All right, so before we prepare the complete set of financial statements, we have to update the trial balance to reflect these adjustments. So this is nothing new. I think this is actually the same chart that they had in probably one of the first lectures, right? This should be no surprise. Net income now flows to retained earnings, which is part of shareholders' equity, right? Nothing new. I got a good question before class regarding this account called dividends declared and dividends payable. So I think one of the first assignment problems was book the journal entry for this transaction, and the transaction was the company declared a dividend of $500 to be paid next month. So the debit goes to this account called dividends declared, or just dividends, and that is a retained earnings account, right? That's what we see as, that's that dividends number here, okay? The dividends payable, the credit side of that transaction, is a liability, and that gets cleared out when we pay the dividend in cash. Contributed capital, nothing big there. That's just the amount of share capital that we've issued. That's all the share capital that the investors have put in. Remember, when we issue shares, we increase contributed capital. To issue shares means we're giving shares, and in return, we're getting cash. Debit cash, credit contributed capital, or credit common shares. Okay, I think we discussed this last time, but the earnings per share, you'll almost always see earnings per share sitting at the bottom of a statement of comprehensive income. and it's a widely used measure. In real life, you'll see people who control hundreds of millions of dollars refer to the earnings per share of a company because it's a very important metric. So it's used to assess the operating performance and profitability of a company. So earnings per share is just the net earnings or the net income, and that, remember, that's just your revenue, that's just your profit, right? Revenue minus expense divided by the average number of common shares outstanding during the period. So the reason we use the average again is because if at some point during the year you issued common shares, well, your balance at the end is going to be higher than your balance at the beginning, or vice versa. You can redeem shares, in which case your balance at the end would be lower than the balance in the beginning. So we don't want to give preference to one or the other because net income is earned over time. Okay, so we use the average to sort of take a middle ground and say, on average, we earned however many dollars of profit per share. Here's an example. If ePhone had $498,000 of net earnings, and the average number of common shares outstanding during the year was 10,799 million, that's worth about 5 cents per share. And that now lets us compare to Apple, lets us compare to ePhone last year. We can make a prediction. If you're an investor and you think earnings per share is going to increase to 6 cents a share, you might think this is a good investment. Okay, statement of cash flows. We haven't gone over the statement of cash flows yet, but again, remember that the 3 things you need to know at this point are that it's built up based on the statement of financial position and the statement of comprehensive income. And that's because the statement of financial position will show you how much cash you have today, and your statement of comprehensive income will show the accounting profit based on accrual, but you won't know how you got from last year's cash to this year's cash. There's a lot of adjustments that have to be made. Okay, so the statement of cash flows is a categorized list of all transactions in the period that affected the cash account, and there's 3 categories. Operating, that's our day-to-day. That's us selling phones. That's us buying the supplies to build the phones. That's us paying our employees to build the phones. Investing activities, that's us buying new equipment. Financing activities, that's us taking on bank debt and paying shareholders dividends. Okay, but there's going to be a whole lecture on this on the statement of cash flows. So we've seen this already. Net profit margin is just for every dollar of sales we have, how many cents of profit do we have? This says how profitable we are. Revenue is not as relevant as you might think. Revenue growth is important, right? Because you want the company to be growing. But if the company has $1 billion of revenue and $1,001,000,000 of expenses, it's losing money, right? So it's important to see how efficient a company is. And again, it lets us compare. If we have $1,000 in net earnings and $5,000 in net sales, our net profit margin is 20%. We can compare to other companies. We can compare to ourselves over time. We saw this already, I believe. Return on equity. That is the net earnings divided by the average shareholder's equity. Notice how we're not, okay, notice what the denominator is. This isn't common shares. This is a dollar amount. Okay, the average shareholder's equity. And this says for every dollar of shareholders' equity invested in the business, here's how much profit the company earned. That's different than this calculation, which is, this is an average number of common shares. Oh, where am I here? This is not a dollar amount of shares. This is just a number of shares, right? This has 5 cents per share. 2 different measures, okay, but they both sort of measure how well the business is doing, just in a different way. Okay, what does it mean to close the books? You'll probably hear this terminology a lot. Closing the books happens once the company has recorded all transactions for the year. They book all adjusting entries, and then they say, okay, we're good to go. Let's close the books. I mean, you can think of it literally as sort of closing the books, that you can't make any more entries for that year. And now you can prepare the financial statements. So this should be nothing new. The statement of financial position, account balances, that's your assets, your liabilities, and your equity, carry forward from period to period. They're perpetual. Your ending cash last year of $1,000 is your beginning cash this year of $1,000. If you owed the bank $10,000 at the end of last year, January 1st comes, you still owe them $10,000. These balances are perpetual and they carry forward. The income statement accounts do not carry forward. You can think of revenues and expenses as buckets, and you fill them up as the year, January 1st is day one, and you fill them up until December 31st, and then you dump them into shareholders' equity. And then they start the new year with zero balances. So on December 31st, you might have profit of $1 million made up of revenue of $3 million and expenses of $2 million. That's December 31st. On January 1st, what are your revenue and expense balances? Zero. You haven't earned anything for that year, right? That was last year. So we're going to go over the mechanics. Again, think of how it used to have to be done before computers could do this. We're going to go over the mechanics of physically transferring the net earnings to the retained earnings, okay? And the reason we have to do this is because if we didn't physically make an adjusting journal entry to zero out the revenues and expenses, what would happen? The balance would just keep building up, right? The balance in our T account for cash is just a long list of debits and credits, right? We pick a point in time to say, here's the balance, but then it just keeps going. If we were to never close out revenues and expenses, they would just keep accumulating. Okay, so this is what I just said. Assets, liabilities, and shareholders' equity are permanent or real accounts and are never closed, okay? Closed is the terminology we're using, closed, to say we're going to bring the balance to zero. Okay, revenues and expenses are called temporary or nominal accounts, and they are closed. We dump the bucket into retained earnings. We empty it. Dividends are also closed to retained earnings. Asset, liabilities, and shareholders' equity accounts carry over from the previous period. They carry over, meaning the balance at the end of the last period is the balance at the beginning of this period. Temporary account balances do not carry over, and the opening balance will always be zero. Okay, that makes sense, right? If you think of how much, when you're working, you think of how much money you earned last year. Maybe you had a good year last year, and then this year you're out of a job. Hopefully that never happens, but this year you're out of a job and your earnings are zero. Right? There's a difference between how much money was earned over what period of time. Okay, so the steps in the closing process, you can think of steps 1 and 2 as actually one step. Okay, we close revenues and gains to this account that you've never seen called the income summary. The income summary is actually a temporary account, and it's just a placeholder. It's just a middle bucket, okay, where we pour the revenues and expenses in that bucket to accumulate everything. To close revenues means we need to get the revenue balance, which might be a credit balance of $1 million. We need to get it to zero. Okay, we do the exact same thing for all expense accounts and losses. We have to get those debit accounts to zero, and we also close them to the same account. We're accumulating everything in this one account. Okay, we're just mixing it all in. Then we take this middle bucket, the income summary, and we close it to retained earnings. Remember how I said net income or net earnings are just part of shareholders' equity because they form part of retained earnings? This is the mechanics by which they actually get closed to shareholders' equity. So we close the income summary. To close the income summary is just if it has a net debit balance, we have to credit it. If it has a net credit balance, we have to debit it. And then we close dividends. That'll be the dividends declared to retained earnings. Okay? So let's see how that looks. We're going to show an example. So here's an example of closing, or to close, we put to zero all these accounts. So sales revenue, service revenue, interest revenue, and gain on sale of land, these were all credit balances for that amount. Immediately before we made this entry, we had sales revenue of $7,440, service revenue of $50, interest revenue of $5, and a gain on sale of land of $300, all with a credit balance because these are revenue accounts. But we debit, we're debiting them all. You can't have all debits, no credits, right? We're crediting our temporary income summary account, okay, just as a placeholder. So you can see sales revenue, it was $77.10, and now we're debiting $77.10. What's the balance at the end of the year? Zero. Okay, the income summary now has a credit balance of $77.95, but we're not done. All we've done is close out all the revenue accounts. If you were to look at a trial balance today, you would see all those, the sales revenue, service revenue, interest revenue, and gain on sale of land will all have a zero balance. The exact same process happens to the expense accounts, except it's reversed because expenses have debit balances, right? So in this case, we have cost of goods sold, which had a debit balance of $33.60, but we're crediting it. Notice, again, it was $33.60. This closes it out. The balance is zero. So we accumulate all of these credits to our expense accounts to offset them, to make them zero, and we put the debit to the income summary, okay? So here we credited the income summary, $77.95. Here we're debiting the income summary, $72.97. The net balance in the income summary is a credit balance of $498, right? That's going to be your $77.95 less your $72.97 gives you a net credit of $498. Okay, so we have to close the income summary, but again, you can't have a one-sided entry. So if we're debiting the income summary such that the balance is zero at the end of the period, we credit retained earnings. Notice how, what's happening to retained earnings? The beginning balance was $64,660. The net impact is an increase of $498 because we're crediting it. So you could have told me actually that if you knew that the net income for the year, do we have an example? If I told you net income for the year was $498, you would know that ultimately retained earnings will increase by $498. Okay? This is just the mechanics whereby you have to go through and close every account. Okay? You generate your income statement before you do this because if you close everything and then you go to see what the balance is in all of your income statement accounts, it'll all be zeros, right? So first you generate the income statement, you say, okay, profit $498. And now you go ahead and you zero out every account and just close them to the retained earnings. So this is the mechanism by which the revenue and expense accounts become part of retained earnings. We have to close the dividends account. The dividends declared account sits as sort of part of retained earnings until we actually close it. And again, that's because we care about dividends. Dividends accumulate throughout the year. If last year we paid $10,000 of dividends, those would eventually be closed to retained earnings. And this year, at the beginning of the year, our dividends declared as zero, right? Until we declare a dividend this year, there's no impact to retained earnings. So remember that dividends reduce retained earnings, right? So we credit dividends declared, debit retained earnings. The impact is now that Our ending retained earnings, 28,979, is a function of the beginning retained earnings, 28,681, plus net earnings for the year, less dividends. Notice how we have retained earnings has a credit balance, right? We start with the credit balance, decrease by debit, increase by credit, 28,979. So this is just the mechanics by which we close revenues, expenses, and dividends to retained earnings. And this is going to be the ending balance that shows up on our statement of financial position. Post-closing trial balance, post just means after. Post-closing trial balance will be prepared. And how's it going to look? Well, it's going to look similar to the unadjusted trial balance, except we're not going to have any revenue and expense accounts. It's just going to be the balance sheet. Because on January 1st, at 12:01 a.m. January 1st, there's no revenue and expenses. It's just our balances that carry over, just our cash and our debt and our shareholders' equity. And that's the end of chapter 4. So I'll give you guys 15 minutes. Why don't we be back at 8, and then I'll go over problems. Okay, there's 2 problems.